Most people believe that investing like the giants is the only path to wealth. The central problem is that the market giants are literally trapped by their own size. They have so much capital that every move they make creates a ripple in the financial ocean. They cannot enter or exit a position without alerting the entire ecosystem. This problem became evident during the global financial crisis, when large funds faced real difficulties adjusting positions without amplifying their own collapse. If you operate with smaller capital, you possess a tactical advantage that BlackRock will never have. You have the agility of a fighter jet, while they operate like heavy cargo ships. It is mathematically possible to profit about $1 for every 2 invested each year. According to Berkshire Hathaway's shareholder letters, as analyzed by outlets like CNBC and the Wall Street Journal, Buffett achieved returns of this magnitude in his early decades while operating with reduced capital. This is not a marketing promise or a miraculous shortcut. It is a technical observation from Mr. Buffett about the potential of those who do not carry billions on their backs. The raw, naked truth that the banking sector hides is this: small portfolios allow you to exploit structural flaws that large capital ignores out of necessity. The strategic goal should not be to diversify just to feel psychologically safe. The real goal is to concentrate effort where the probability of being right is overwhelming. To change your financial standing, you need impact, not a lukewarm average. Imagine trying to park an ocean liner in a spot reserved for a speedboat. That is precisely the dilemma that the Fed or Vanguard face every quarter. They are forced to buy only what is liquid, what is large, and what is obvious. They need colossal companies like Apple or Amazon to be able to allocate their cash. If they invest in a mid-sized company, they end up accidentally buying the entire company. You do not have this liquidity restriction, and that is your greatest asset. You can navigate markets where the spotlight of analysts hasn't yet reached. Smaller companies with scant or non-existent coverage from major analysis houses. Places where the screen price and intrinsic value rarely walk hand in hand. Harry Markowitz, who structured all of modern portfolio theory, advocates diversification as a rational basis for dealing with uncertainty. This view directly contrasts with Warren Buffett's, who is extremely emphatic about the nature of diversification. For him, diversification is expensive insurance against your own lack of knowledge. If you dedicate time to understanding a business, spreading your money dilutes your success. Holding 50 different assets is the shortest path to guaranteed mediocrity. In his view, focusing on just 3 main assets is the gold standard for the professional investor. He has always championed concentration when conviction is deep, but acknowledges that this requires a level of understanding that most investors do not possess. Some studies suggest that holding between 25 and 30 stocks reduces the statistical risk of the portfolio. But reducing risk does not, in any way, maximize your return. On the contrary, the more you diversify, the closer your profitability becomes to the market average. The gains that truly change lives come from concentrated, conviction-driven decisions. Large returns are often directly linked to concentrated decisions and increased risk exposure. It is the technical difference between merely protecting wealth and building a fortune from scratch. But do not confuse conviction with arrogance. During the long-term capital management collapse, a fund led by some of the biggest names in financial mathematics collapsed precisely due to a lack of humility and leverage. Many beginner investors give up because they think $500 a month is irrelevant. They ignore the physics of compound interest operating over long time horizons. With $500 a month, the investor puts in just over $250,000 over a lifetime and ends up with more than $2.5 million. The difference isn't effort. It's time under compound interest. Over decades, consistent contributions can grow significantly. The final result depends directly on the rate of return and discipline over time. The secret is not in the initial amount, but in the efficiency of the vehicle where you place the capital. Approximately 7 out of every $10 of your contribution should support the world's largest economy. Many investors opt for strong exposure to the United States due to its historical relevance. We know there is no guarantee that the next 50 years will be like the last. Still, the American market remains the most resilient growth engine in history. The strategy involves using index funds with nearly invisible management fees. Large institutions offer structures where the maintenance cost is just a few cents. High fees are the parasites that devour your million before it is even formed. John Bogle summed it up directly. In the long run, cost is one of the most determining factors in the final result. Buffett's #1 rule is clear: never lose money through negligence or unnecessary costs. He has stated that if he were starting over today with few resources, his tactics would be different. He wouldn't seek out the giants of the S&P 500, but rather what he calls cigar butts. They are cheap businesses, misunderstood by the public, but with one last puff of value. In this specific niche, he believes it is possible to extract returns of approximately 50% per year. Buffett achieved extraordinary returns with the cigar butt strategy early in his career, abandoning this approach as his capital grew. This is only possible because you have the freedom to buy tiny positions. Moving around $100,000 a month is something that doesn't even faze a large fund. For the individual investor, that volume is enough fuel for independence. Do not fall into the trap of imitating hedge funds and their abusive fee structures. Buffett proved in a historic bet that passive management beats the so-called geniuses. Over a decade, a simple index outperformed 5 elite funds by a wide margin. Keep your transaction costs near zero and your patience at high levels. Leverage your agility to enter inefficiencies that billion-dollar algorithms ignore and that may go unnoticed by large institutional structures. One of the best trades I've ever seen involved no billions, no algorithms. It was a regular investor exploiting an ignored small cap, something that simply wouldn't appear on an institutional fund's radar. The systematic reinvestment of every dividend cent is what accelerates the growth curve. Time and discipline are the only assets that institutional money cannot steal. Take advantage of the phase when your portfolio still allows for this maneuvering speed. The day will come when you will have the problem of having too much money to be agile. At that point, you will have to become cautious and accept the safety of the giants. But while you are in the accumulation phase, the game is different. Today, the game belongs to those with sharp vision for what billions of dollars are blind to. Focus on quality, ignore the noise of the news, and let time work in your favor. Friedrich Nietzsche observed that what is most valued by the crowd is rarely what has the greatest depth, an idea that repeats itself in the markets. Stop letting your portfolio's size be your excuse when it is actually your greatest tactical edge. While the giants are trapped by their own liquidity, you have the agility to strike where the big money can't follow. If you are ready to stop diversifying into mediocrity and start building real wealth through concentration and logic, subscribe now. Join our community of high-level investors who value precision over noise. Hit the notification bell to master the strategies that Wall Street ignores, and let's accelerate your compounding curve together. Your edge starts here.